Hi everyone, myself Pruthi. Today I welcome you all for a basics of stock market series. In this video I will be explaining about what is stock market, how does the stock market functions and types of markets in the stock market, and how can you generate return from stock markets. So let us focus on what is stock market. Stock market is financial instrument where it is listed in the stock market, where it is publicly traded in the real time basis. So what are the financial instrument listed in the stock market is that first one is ETF, exchange traded fund, companies will be listed, and bonds, debenture will be listed. Next, index mutual fund will be listed. Next, derivatives will be listed. So these are the financial instrument which will be listed in the stock market to trade in the publicly in real time basis. So from when to when the market will be open? From Monday to Friday, 365 days, except the compulsory holidays, the market will be opened. It will open at 9 o'clock in the morning and it closes at 3:30 in the evening. So in between, one market will be there that is called as a pre-market. It starts at 9 o'clock, ends at 9:15. So why does the pre-market exist? The pre-market exists because before 9 o'clock there is a huge buy order will be placed and huge sell order will be placed to simultaneously. So to match that, there will be a lot of volatility will be there in the market. To counter that, the pre-market session will be placed so that to avoid it, the market will be settling the price of a buy order and sell order and it will be available for trading at 9:15. To counter this, the pre-market session has been established from 9 to 9:15. So let's start with how does the stock market functions. Stock market functions based on two things, a demand and supply. So when the demand is more, the stock prices will gonna move up. When the demand is less, stock prices will gonna move down. So depending upon that, the prices will gonna fluctuate based on the demand supply positions. So stock market functions based on the two perspective. One is from a company perspective. Stock market functions, the company requires a fund. It has to raise a fund so that they are going to sell their stakes in the company to the investors, so they can raise the fund, they can invest in the companies, so they can grow for the future. So for the growth purpose of the company, they have to sell the share in the stock market and raise the fund, utilize it for their growth purpose in the company. So what is the benefit for them? The benefit is that if they want to raise the fund, they have to borrow the money from a banks. If they want to borrow the money, they have to keep a collateral of the company and they have to raise the fund at a certain rate of interest. But if they are rising from an investor, they need not to give a collateral, they have to sell the shares. If they want to take buyback, they also have a buyback option. They can buy back the shares after selling the shares when the company get into the profitable zone. So this is how the company perspective will be there. When it comes to an investor perspective, the advantage is that the investor can become an owner of a company at a some part. Even if you have one share of a company, you are still a owner of a company. So you can participate in the growth of a company by taking a share of it. So what is the return you will be getting is that the dividend will be getting, and you can convert the cash what you will be having, you can convert that cash into the financial assets. So this is what an investor perspective, this is how the stock market functions. So let us understand what are the different market is involved before the stock market. So types of markets is involved in the stock market is that one is a primary market, another one is a secondary market. What happens in primary market? What is that? So the company has to raise a fund, they have to come to the primary market so they can raise a fund with the issue of IPO. IPO means an initial public offer where there will be fresh issue of the shares will be called as a initial public offer. They will issue that. They have to submit all of the information about the company to the SEBI, and SEBI will going to give a clearance for a company to raise a fund through the primary market issuing an IPO. So in the primary market, there are a lot of corporate action will be done. One is a QIP, qualified institutional placement, and preference share issues and buyback of the shares is going to be a further follow-on issue of the shares. This kind of the private placements will be involved in the primary market. So if you want to know all these primary market functions, please let me know in the comment section. I'll be doing another video about that. So this is how the primary market functions. In the primary market, what happens is that I'm going to give you an example for it. So in the recently, the Burger King was an IPO was there. The issue price of an IPO was 60 rupees. So the price of an issue is 60 rupees, but it is listed at 120 rupees. So almost the investor amount which they have invested in the Burger IPO, it has doubled in 1 month. So they have invested before 2 to 3 weeks back. After listing, they have got a return of doubled. So after that, stock has rallied to 215. Again, it has come back. Now it is settled at 150. So the entering in the share in the public primary issues. So primary market in the initial public offer. This is an advantage of getting in listing gains. So this is how the stock market functions. So in the next is a secondary market. What happens is a secondary market is that whatever the fund will be raised in the by the companies in the stock market like a IPO, the IPO should be listed in the secondary market to be traded. So in the trade, when it is been listed in the secondary market, the people, those who have entered in the public issue, they can exit from the public issue. The people, those who are not subscribed in the public issue, initial public offer, they can enter it. So this has the option in the secondary market. So in the secondary market, there are other corporate option will be there. One is a dividend issue will be there. Next, stock split will gonna happen. Next is gonna bonus share issue. This kind of things, corporate actions will be done in the secondary market. They will going to issue it. So next, what is the return you can generate by investing in the stock market? So what is the return you will be getting by investing in the stock market is that. So if you invest in a bank deposit rather than investing in the stock market, you can get a fixed rate of interest like a fixed deposit keeping in an FD and debentures like a bond. So what's the return you will be getting by investing in FD is that the return of rate of interest, the return you will be getting. Next, is it taxable? Yes, it is taxable. Depending upon its 30% in the TDS will be deducted in that interest what you are keeping in a bank. So when it comes to investing in the stock market, you will be getting a shares by investing in the stock market, and you will be getting a return as a dividend. So you will be getting a dividend. Is there mandatory to give a dividend in stock market? No. So the company may announce dividend, company may not announce dividend. It is not mandatory. So is there any example for it? Yes, there are many. There are 2-3 examples. For in India, DMart. So since from listing, the DMart has not given a single penny of dividend to the customers, to the investors. So next, it is like that. So is it taxable? So yes, it is also taxable. There is also some exemptions is there. So LTCG, where LTCG means long-term capital gain tax. If you are holding it for more than 1 year, you will come under long-term capital gain taxes. So it is 2.5 lakh exempt for an individuals. So depending upon the age factor, the long-term capital gain tax has been exempted. So if you want further knowledge about the taxation structure in LTCG, so please comment below in the comment section. I will be explaining about that. So this is what is the return you will be getting by investing in the stock market is that one is a dividend, another one is a capital appreciation. So when the price get moving upper and upper, so even if you are not getting dividend, so the capital appreciation will be there. So from that the returns will be more. So this is what is the return you will be getting by investing in the stock markets. I think I have cleared you the basic things what is required for to invest in stock market. In the next video and all, I'll be covering more basic knowledge about the stock market. If you want to know a specific video to do, please comment below in the comment section. I'll be explaining all those also that. So thank you all. Bye bye.